Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel comparing level production and seasonal production, thinking about the decision as to whether to have level production or seasonal production. Get ready. It's time to take your chance with Corporate Finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that information into the blue area into our worksheet on the right-hand side. We're thinking about a situation where we're thinking about going from a seasonal production process to a level production process. So we are imagining a situation where our sales is seasonal. We have some months where we expect to sell substantially more than other months. We currently have a seasonal production process that's generated or it's designed to line up so that we produce more for the months that we expect to sell more, prepping for that time period, meaning we have to ramp up the production process in order for us to meet those sales and then decline the production process after that point so that we can basically have a production process that's going to be lined up to what we believe the sales will be. Why would we do that? It reduces the amount of inventory that we're going to be holding. And so that could be a benefit in that case. Now, the other method that we can't use is to have an even production. We might say, let's take the entire year. Let's just figure how much we're going to need the entire year and then just produce evenly every month throughout the year. And there's pros and cons we've discussed in prior presentations with regards to that. But the benefits that we're going to get from a system like that is we're going to be able to be more efficient with our production process because we're going to be standardizing the units that we're going to produce. We don't have to pay like overtime when we're trying to ramp up production or worry about our machinery overworking the machinery at the point in time that we're going to be ramping up the production. We're just going to produce evenly through the year, even though we have uneven sales that we expect to be happening throughout the year. Obviously, the downside to that is then we have the added costs of us carrying inventory for those months where the production is going to be lower in the seasonal trends. So let's think about what would happen if we're going to move to a level production. If we're going to move from seasonal production to more of a level production, we may have an after-tax costs decrease due to the added efficiency. So we'd have to say we think the added efficiency is going to save us costs, possibly in terms of like overtime and just being more efficient within our production process. It's going to be cheaper for us to produce the inventory if we are able to do a systematic process through the year, and we think that that's going to be saving us the $41,000. We have to balance that then against the cost of us holding on to inventory. And so, for example, if the inventory increases to $460,000, then we have to think about what's the cost of us holding that inventory. How can we balance these out? Possibly we're going to be having the production process and we need to be then financing the production of that inventory. So we might have financing costs as the primary cost basically of us holding inventory that we're not selling because we had to finance the production process of it, and then we're not selling it until later on in the seasonal production process. So we could have then the added financing costs that we'd have to balance between these two. So if we think about this from a static type of standpoint, we can say, all right, if there's a decrease in the cost, we're going to say we're going to be saving this $41,000, but then the financing cost that we're going to have, or the increase in financing cost, is going to be the $460,000 we're going to save times the 10.5%. I'm going to say it's the $460,000 times the 10.5%. So we're figuring the financing, and if we subtract those two out, then we're at a loss, and we have a loss on the change. So if we were to change, then it would be a negative impact, so we would think we wouldn't want to change in that case. We would want to do the more inefficient production process because the added cost of us financing the inventory is more than what we would save by being more efficient producing throughout the year. If I go to the Home tab, Font Group, and Underline, now we might think, well, how low does this rate need to be before it might be a good decision for us to then go to the standard production process, or what would be like the break-even point between the two? So if we had, once again, a decrease in the costs here, so we got the decrease in the cost at the 41, and then we've got the inventory increase, which is going to be this 460. And if we divide that out, we're going to say this is going to be the 41,000 divided by the 460,000. Make that a decimal. or a percent home tab number group, percentifying it, adding a few decimals. Let's put the underline here, home tab font group and underline. So this is going to be the equilibrium interest rate. And we can kind of prove that. We can say, okay, if I prove that up here, I can say, all right, if I had the 41 here, and then to then take the 460 times the 8.91 about, then we would be matching up, and this obviously minus this would give us our even point. I'm going to make this, I'm going to format this for us. I'm going to make it drop down here. I'm going to make it that blue and the lines, and let's add a black line up here so that we have that. Let's put an underline, home tab, font group, and underline. That should be there on your worksheet already. So that's going to be, kind of a simplified process for us to think about this decision, Well, would it make sense for us to have a seasonal production, or would it make sense from a cost perspective to have a production that would be more of a level production? And so you can start to think through the factors that would be involved in that.